Today, I'm going to be unpacking the top 5 things that I think are going to have a big impact on how the Toronto area's housing market evolves in 2025. And these are the top 5 things that I'm going to be keeping an eye on. My name is John Pasalis. My team and I help buyers and sellers throughout the Toronto area make smarter real estate decisions. If you'd like to meet with me and my team, just click the link in the show notes below or send me an email at askjohn@movesmartly.com. So as we move into the new year, I think it's helpful to be mindful of some of the key things that will ultimately shape the outcome for the Toronto area's housing market in the year ahead. Obviously, we can't make any strong predictions, but there are clues. There are certain things that we know are likely going to happen and transpire and evolve. And these are the things that I think we need to be keeping an eye on. And many of the things I'm going to be chatting about today directly or indirectly relates to the houses and condos and rental units that are currently under construction today. So if we look at a chart of what is under construction, and I used Ontario rather than just the GTA because there are spillover effects. Ontario has just about 90,000 or just over 90,000 condominiums under construction, 40,000 purpose-built rentals, and just over 20,000 low-rise homes. Now, the most important segment of these stats are the condominium market because they make the biggest share, and the rental market. Now, the condominiums, of course, many of them were bought by investors, so are effectively rental supply. So we effectively have just under about 130,000 condos and purpose-built rentals, many of which will be entering the rental market. So when we think about all of these properties under construction, there are a couple of things that are going to impact how the market evolves. And the first thing we need to be keeping an eye on as we move into the new year is the completions, the condo completions in 2025. Will there be any issues? Will investors have a hard time closing? The big issue is going to be that many of the investors that bought those units bought them 4 or 5 years ago at very elevated prices. And resale prices have been flat for 4 years. So in most cases, the investors are going to be taking possession of a unit that is not worth what they actually paid for it. And I talked about this in one of last year's shows, and I looked at one building in particular, 55 Mercer, where we saw these dynamics. So just to unpack kind of what was happening last year, if an investor paid $1,500 a square foot for a unit and they took possession, in many cases, those units were only worth $1,200 a square foot or $1,250. Now, normally what happens in those scenarios when you buy a unit and it isn't worth what you paid for it, the banks typically ask you to put more money down. And even though the investor put down, say, a 20% deposit, if the prices fell 20%, then they effectively have no equity in the property because whatever they put down as a deposit has disappeared in value. So typically, the banks require you to put down 20% of the new reduced value. So if you take a 1,500 square foot unit, it has dropped to 1,200. The banks are asking you to put down a down payment based on the new reduced value. And you would need to come up with probably an extra 20% down because your original deposit has been wiped out. Now, what happened in 2024 is banks, for the most part, didn't really do that. In many cases, they turned a blind eye. They use what are called blanket appraisals, which basically means that the banks pretend that the property is worth what the investor paid for it. So the investor doesn't need to come up with that extra capital to close, that additional 20% of the value. They still need to qualify for the mortgage, but I'm sure banks were very relaxed in approving those. Now, why were banks doing this? I mean, for the most part, most of the differences in 2024 were relatively minor. Maybe the purchase price has declined about 10%, so the values have declined 10 to 20% from what investors pay for. Banks could get around that type of a decline. And the other reason they did this is that, number one, the banks are very motivated to see these buildings close. Now, what happens if 30 or 40% of the unit owners couldn't get their mortgage? What happens if they default and said, you know what, I don't have the extra money, can't qualify? Well, we have massive problems. I mean, in cases like that, the condo project as a whole will not complete. It will not register. The builder doesn't have enough money to pay off all their loans to complete the project to register, which means the whole project is effectively in jeopardy. And we saw this in the US during the financial crisis and many of the booming condominium sectors in Miami and Las Vegas. Many of those units never closed. Many of the purchasers defaulted and walked away because they didn't have because the unit was worth less than what they paid for it and they weren't interested in closing. So many of those projects failed. So this is what the banks are trying to avoid. This is what the banking regulators are trying to avoid by breaking the rules effectively. Now, as we move into 2025, it's going to be a little bit harder for them to do that because the difference between what investors paid and what units are going to be worth is going to increase significantly. So they're not going to be down 10 or 20%. You know, we might see some completions that are down 30 to 40% from what the investors paid for it. You know, investors paying $1,650 a square foot and it's only worth $1,200 a square foot. There's a ton of irrational exuberance fueling the pre-construction condo market. You know, 4 or 5 years ago, even as late as 2021, people just assumed prices would keep going up forever. The experts told them we have a supply shortage, prices will keep going up, we just need to build more homes. And this filled tons of irrational exuberance, and it really pushed condo prices way higher than they otherwise should have been or would have been if we didn't have that. So will there be issues on closing? This is kind of one of the key things we need to be keeping an eye on. If there are, we might see challenges in condo projects closing. My instinct is most of this will be dealt with behind the scenes. I would be a little bit surprised if we have condo projects failing. The more likely outcome is, you know, some institutional investors will be coming in buying blocks of units at effectively distressed prices. The original investors will still be financially responsible for any decline in value, but much of this will be dealt with behind the scenes. So I would be surprised if we see any distress, but regardless of how it plays out, I think it's something we need to be keeping an eye on because, again, if institutional investors or large REITs are coming in and buying them up, I mean, I think that's going to be an important development for us to be keeping an eye on. So completions, whether investors are able to close, whether they default, you know, and the potential risks that this has on the housing market and the economy. And again, many of the risks are isolated to those projects, but the wider risks are confidence, you know, the sentiment of the market. Once you start seeing condo projects failing, it shifts the entire mood. People panic. People don't want to buy. People move to the sidelines. So these are the bigger issues that could shape the outcome of the market. It's not so much if one condo project fails and the builder defaults. It is that one project can completely shift the sentiment in the market. So we'll have to keep an eye on how those things unfold in the year ahead. Now, the next important thing to keep an eye on is the rental market. You know, as we said, many of the units that are going to be completing in the year ahead, we're going to have 30, whatever it is, 40,000 units completing between purpose-built rental and condominiums. Many of those at one point or another are eventually going to hit the rental market for the most part. And this is going to see again, a surge, another big increase in supply hitting the market. Now, this isn't out of the ordinary to see, you know, 30, 40,000 completions, condos or rentals hitting the market at the same time. This is very typical. However, it's particularly critical to look at it from a different lens because things are going to be very different in 2025 for two reasons. Number one, when we look at our starting point in terms of the number of houses and condominiums listed for lease on the MLS system, which is the main system that brokers use, we are at a historic high. In December of 2024, there were 16,000 properties available for rent, significantly higher than historical norms for the month of December. So we're starting with a lot of inventory on the market. And that's the first important thing. Our inventory levels are high, so we're going to have more inventory coming on when inventories are already elevated. If inventory levels were at 30-year lows, we would be less concerned, but inventory levels are already quite high. On top of that, we're starting with a elevated level of inventory, but demand is likely going to be considerably lower in 2025. And the primary reason for that has to do with the federal government's changes to their population targets, and in particular, the number of non-permanent residents. Canada's population was growing by 1.3 million people last year. If we look at what the projections are for 2025 and 2026, our population is actually expected to shrink. It's going to be negative in the next 2 years. Again, assuming the government sticks to their population targets. This federal government, the Liberals appear to be sticking to that. We'll see what the Conservatives do. But if that happens, Canada's going to have negative growth, which means our population is actually shrinking. So we're going to have more housing completions and without a lot of new demand. So when we think about Canada's housing shortage, the housing shortage is reflected in today's prices, both resale prices and rents. But when you have, if we just look at Canada, for example, if you have Canada completing 200,000 properties in 2025, and negative growth, well, we're eating into that shortage, right? We're building 200,000 homes without a ton of new demand hitting the market, which means one of two things are going to happen. Either it's going to put a little bit of downward pressure on prices or some downward pressure on rents. And the most likely scenario in the Toronto area is going to be more downward pressure on rents because the decline in Canada's population is going to be largely from non-permanent residents. Our immigration numbers are still going to be relatively high, just under 500,000. But the number of non-permanent residents will be declining by more than 500,000, which is why our population growth will be negative. So non-permanent residents are typically renting properties, which means that the rental market will likely be softer in the year ahead. And we'll probably see some downward pressure on rents as the supply of new listings and existing listings exceeds new demand for rentals. So, that's the second, I think, important thing to keep an eye on, the rental market, because it does impact what happens in the resale market. So the third key thing I think is going to be critical is what happens in the condominium resale market. And by that, I mean the units that are listed and available for sale. And I think we could see a couple of different trends. I think the trend that we've been seeing in 2024 is that smaller units are harder to sell because they are investor owned, and there just isn't a ton of investor demand right now for resale units, and more investors actually exiting than entering right now. And the reason for this is a few things. I mean, prices are no longer increasing and rents are falling. So a lot of investors think, well, why am I hanging on to this property? Many of them are cash flow negative, which means that the mortgage payment, taxes, and all the expenses exceed their rental income. And many people were fine being cash flow negative in an environment where their condo was going up 60, 70 grand a year. No one wants to do that when it's not going up or it's potentially going down. So I think the condo market for small units will continue to be challenging. I think a lot of investors were thinking, I wanted to sell in 2024. I'm just going to wait till 2025. Again, it's hard to predict, but my instinct is I don't think it's going to be materially better in 2025. The market could be a little bit more challenging. Again, if rents are going down, we may see potentially some downward pressure on condo prices as well. And again, I think we have to keep in mind, if you're looking at buying a condo, that there are different markets. The larger units, the 2 bedrooms, the 1,200, like those are going to be different segment of buyers than the tiny 500 square foot studios and 1 bedrooms. And those 2 markets can do different things. One could be more active and selling relatively quickly, units that are geared towards end users, whereas the investor units could be more sluggish. So the dynamics in the rental market, and in particular the different segments of the dynamics in the condo market and the different segments of the condo market, I think are the next key important thing that we should be keeping an eye on. The fourth thing are economic headwinds. I mean, we've already seen, despite the fact that Canada saw strong job numbers over the past week, these are, we can't take these measures too seriously. Those numbers are quite volatile. But generally, Canada is seeing challenging economic headwinds, and I think the one key thing, going back to my original point about the condo completions and the housing completions, is that as we move into 2025, if 40,000 units, housing units get completed, it's very likely that we're not going to see 40,000 new starts. Starts will be a lot slower than completions. Part of this is because no one's buying new housing right now, despite a apparent housing shortage. The prices are quite frankly too high. Developers will not lower them. They're just going to wait for the market to rebound. So this is going to lead to a decline in housing starts. And when you have a decline in housing starts and completions outpacing starts, what happens is you just have people potentially stop working. I mean, it eventually might lead to some layoffs in the construction industry if they're not starting a ton of new projects. And this, of course, has ripple effects in the economy. Construction is a big sector of Canada's economy. So how Canada handles that, I think, will be quite important. Of course, other economic concerns across Canada and with the new Trump government and tariffs, but I think the housing market and the construction sector will be quite important because it is such a big factor. How will the government manage that? And we don't know yet. I mean, there's a lot of push to reduce taxes on new houses. The hope is that the builders will flow those reductions in taxes to new buyers. I mean, in the case of condos, predominantly investors buying tiny units potentially, but there's no guarantee that builders will flow those cuts through to end users. Builders could just take those and just wait for prices to hit what they need, and those tax cuts become effectively increases in their underlying profits. So we don't know what the government's going to do, and we don't know how builders will respond to whatever policies they put in place. Again, what the Liberals might do in the short term is one thing. What the federal Conservatives, assuming they win the next election, which seems pretty much like a slam dunk, is a whole other thing. They appear to be focused on cutting HST or GST on new housing. And I wonder what they will do to Canada's population growth targets. I mean, I think last week on our roundtable, I said there's no chance they're going to change it. But I do wonder if that's the case. I mean, if the economy is struggling and, our negative population growth is impacting housing, it's very possible that the federal Conservatives change course and ramp up our population growth targets again to support the housing market. Again, politicians will go to great lengths to prop up the housing market. It's not a free market. It's very much a rigged system. So we'll see what the federal Conservatives do. And the last thing I think that's going to be key to keep an eye on is, of course, interest rates and how they evolve over the year ahead and how they impact the housing market. I think there are a lot of people who are very bullish that rates will return to historic low levels. And I think that, of course, is very unlikely. The key things that we need to be keep an eye on are, of course, the two interest rates that impact housing. One is the variable rate, and the variable rate is driven by what the Bank of Canada does. So anytime we see in the news says the Bank of Canada cut interest rates by 0.25% or 0.5% or 50 basis points, that flows through into a lower variable rate mortgage that has no impact on the 5-year mortgage. 5-year mortgage are driven by 5-year Government of Canada bond yields, and those are highly influenced what's going on in the US. And the US economy is booming, which means when the economy is booming, we're less likely to see fixed rates decline in that environment. So while we might see some cuts in variable rates or the Bank of Canada rate, it's very likely that we could end up this year with rates hovering around 4%. And I don't think that is a level that will lead to a booming market, especially with prices at these levels. And I think my instinct is going to be it's probably too high for a lot of investors. So that segment's going to be challenging. And even in the low rise market, it's likely going to lead to a relatively boring market in the year ahead. I think even with our federal government's policy changes, increasing the cap on insured mortgages from 1 million to 1.5, increasing amortizations. This will have a bit of an impact, more on the low-rise market, so for semis, detached townhomes, than in the condo market. But again, I don't know if we're going to be returning to a booming market in 2025. It's likely going to be sluggish, quiet, boring, as the market adjusts, quite frankly, to the combination of these relatively high home prices and high interest rates. I hope you found that helpful. If you have any questions, please post them in the comments below or shoot me an email at askjohn@movesmartly.com.